Hello, I'm Adam from Palmer's Accounting. Over the years, we've worked with hundreds of small business owners. And while every business is different, we see the same accounting mistakes coming up again and again. In this video, I want to share the top 5 mistakes small businesses make and, more importantly, what sits behind them. The first mistake is not truly understanding profitability. A lot of business owners can tell you their turnover, but they can't tell you how much they need to sell and collect each month just to stay afloat. There are often very little focus on gross margin, and that's a number that tells you whether your pricing works, how efficient the business is, and which products or services are actually making you money. Without tracking gross margin properly, it's almost impossible to make good decisions around pricing, staffing, or growth. Pricing is another big one. Many businesses set their prices by looking at competitors rather than their own costs. That assumes two things: that the competitors are pricing correctly and that they have the same cost base as you. Both are often wrong. Discounting is where this really shows up. A small discount can have a huge impact on profit. For example, if you're running at a 30% gross margin and you give a 10% discount, your margin drops to 20%. To make the same profit, you now need to sell around 50% more. For most businesses, generating 50% more sales is unrealistic, and even if you could, it would usually require more cash, more time, more stress. This is often a real eye-opener when we walk this through with clients. Another issue is not reviewing prices regularly. Many owners are nervous about putting fees up because they don't have a clear pricing methodology in the first place. The third mistake is putting all the energy into winning new clients and not enough into keeping existing ones. Businesses that grow sustainably tend to retain clients well. Research suggests it can cost up to 8 times more to win a new client than to retain an existing one. Yet there is often very little focus on client feedback, cross-sell, upsell, or referrals. Talking to existing clients tells you what they value most, where you can add more value, and it often leads naturally to referrals without any marketing spend. For very small businesses, another common issue is how the owner pays themselves. We often see owners paying themselves whatever is left at the end of the month. That leads to inconsistent drawings and personal financial stress. In limited companies, there's also a lack of understanding around dividends. You can only take dividends from retained profit. If you take too much out, you'll end up with an overdrawn director's loan account, which can become very expensive from a tax perspective if it's not dealt with properly. This all comes back to planning ahead rather than reacting after the problem appears. Finally, for newer and smaller businesses, not separating personal and business finances is a big issue. Money comes out randomly. There's no clear pay strategy, and it becomes hard to understand what the business is really doing. Clear separation makes the numbers easier to read, decisions easier to make, and problems easier to spot early. Most of these mistakes don't happen because business owners are careless. They happen because no one's ever explained how the numbers actually fit together. Our series Behind the Numbers is all about changing that. If you recognise any of these issues in your own business and want help getting clarity around your numbers, speak to us here at Palmer's. And if there's a topic you'd like us to cover in more detail, then please drop a comment below, and we'll see you next time.